This strategic analysis of Unusual Machines, Inc. validates their recent defense contracts, but it also asks a critical question. Does the operational reality justify all the excitement? Let's jump straight into our first point. To really maximize the impact here, the analysis needs to bring the tension between revenue growth and the company's actual operational performance right to the front, much earlier in the structure.
Right.
So there's this key theme running through the material, this dichotomy. On one hand, you have all the excitement around these confirmed contracts.
The big ones, the $3.75 million PDW order and that $12.8 million from Strategic Logics.
Exactly. And on the other hand, you have the underlying financial reality. The analysis is clear that Q3 2025 profit, it wasn't from operations.
Not at all. It was driven by a $5.8 million unrealized gain.
From trading securities. Meanwhile, operational income is still deep in the red.
And that's all laid out clearly, but I think the placement, it just feels strategically weak. I wonder, have we really considered how much stronger the whole premise would be if that operational shortfall was framed as the primary risk from the absolute outset?
From page 1.
Yeah. Right now, that whole challenge is sort of tucked away. It's labeled a crucial detail in Section 3, instead of being the core crucible, the test against which all this contract news should be measured.
I completely agree. That structural choice, it lets all the air out of the narrative tension. When you delay introducing the negative operational income, the contracts just look like pure wins.
When they're not.
They're absolutely not. They're existential. It makes the later financial analysis feel like a footnote, like an asterisk, instead of the main event.
Exactly. The material even says it. The bulls are betting these orders will turn the company cash flow positive in 2026. That bet, that's the whole story.
That's the drama.
It is. If the first thing a person sees is that negative burn rate, that's $16 million in new contracts, it instantly changes. It goes from being a nice little boost to a critical ticking clock lifeline.
So the weakness here is really just in the sequencing. By treating the operational loss as a detail you get to later, the report misses the chance to frame the entire piece around these incredibly high stakes.
Which is turning a cash-burning company into something stable.
So the suggestion, then, is to completely reframe the analysis. Start immediately by establishing the high stakes of this operational gap.
Right. Use those confirmed contracts not just as some bullish thing to get excited about, but as what they are. Urgent, necessary lifelines to fix this negative cash flow.
And maybe before they have to raise more money and dilute everyone.
That's the other ticking clock.
The analysis has to hit you with that core conflict immediately. So, for example, one way to do it, you could take the main takeaway from Section 3.
That the stock is surging on future revenue, not current profit.
Yes, and move that statement right into the opening narrative, into Section 1. You'd immediately anchor all the good news about the contracts in the stark reality of the burn rate.
And building on that, you have to make that gap feel real, tangible. The analysis needs to explicitly connect the negative income to the immense pressure on these new orders.
They can't just be a number on an order book.
No, they have to become actual, tangible, operational cash flow. And soon, by 2026. Otherwise, the company is facing a very, very serious funding problem. And that elevates the entire risk profile. It links the contract success directly to the company's survival.
And by leading with that fragility, that volatility, the analysis really earns the right to then explore the upside. It stops feeling like a standard financial update.
And it becomes a high-stakes investigation. A turnaround story.
It also clarifies the quality of that Q3 profit you mentioned.
It was paper profit.
Right, not product profit. And that distinction is just crucial. If they hadn't gotten lucky on that securities trade, the whole quarterly report would have looked completely different.
And the market reaction probably would have been a lot less enthusiastic.
Okay, moving on to our second major point. And this really flows directly from the financial tension we've just been talking about. We need to deepen the analysis of the geopolitical moat's durability. So, while the geopolitical context is a strong case for UMAC's market position, the analysis could be so much stronger if it really considered the potential lifespan of this blue UAS advantage.
It makes a very strong case for the unstoppable argument. It highlights this geopolitical moat.
Which is huge. The U.S. government's blue UAS program is aggressively banning Chinese components. It's creating a massive vacuum in the domestic supply chain for small drone parts.
And the argument is that UMAC is perfectly positioned, right? Their NDAA-compliant Brave F7 flight controller, the U.S.-made motors, they're filling this need. The analogy used is they're selling shovels in a gold rush.
Which is a great analogy. It's very effective. They are compliant, and in this defense market, that is everything.
Yes, it's brilliant positioning.
It really is.
But, okay, this is where we need to inject a little skepticism. Could the evidence also suggest that this vacuum, while it's very real, might also attract competition, and fast?
Good question.
The analysis correctly points out there are almost no US-based manufacturers building these small, cheap drone parts at scale right now. But a moat's effectiveness, it depends entirely on the barriers to entry. How hard is it for someone else to get in the game?
And what's missing for me is that rigorous assessment of those barriers. Because if the operational income is negative, like we just established, UMAC needs this compliance advantage to last.
Long enough for them to scale up.
Right. To ramp up sales and reach profitability. If the barrier to entry is just, a bit of paperwork, their edge could be gone really quickly, right when they need it most.
Precisely. If it only takes a few months and a little bit of capital for a big domestic competitor to switch their supply chain, then UMAC's first mover advantage is just temporary.
It's a head start, not a moat.
Exactly. We need to define why UMAC is uniquely positioned beyond just being first. Is there something structurally difficult here?
The weakness is that the geopolitical argument feels a little passive about disruption. It establishes that there are no competitors now, but it doesn't really stress test how hard it would be for new players to show up.
So the suggestion is to bolster this moat section, analyze the structural reasons why this vacuum has existed for so long, and what specifically stops other US companies from scaling up to fill the same niche.
We need to prove this moat isn't just a shallow ditch.
Right. And concrete examples are what turn a general point into something you can actually use. So the analysis could look at a specific barrier to entry. For instance, what's the typical timeline or the capital required for a competitor to get full NDAA compliance for equivalent parts?
Is the testing and approval process itself a gatekeeper that takes years?
That would be a real moat. Or you could look at their actual products. What's the specific technical advantage of the Brave F7 flight controller? Do they have a patent?
Or a proprietary design? Or maybe a scale advantage in manufacturing that someone else can't easily copy in the near term?
That's the key. That changes the argument from just, we are compliant, to, we are compliant and we're technologically or logistically superior, which makes us very hard to copy.
And that distinction is vital if the analysis is going to justify a high valuation that's based on future dominance.
Yeah.
We need to be confident that as long as the NDAA bans Chinese parts, UMAC has a real sustained advantage that can actually deliver the profits they need to survive past 2026.
Which feels like a perfect transition into our final point. Given the fragility from the first point and the need for durability in the second, let's talk about the stock's price dynamics. The goal here is to enhance structural cohesion by integrating the financial volatility with the operational reality.
Okay, so this powder keg setup, the technical analysis highlighting the low float and high short interest, it feels really isolated right now in the forecast section. And integrating it with the operational reality would create a much more holistic critique of what's happening with the stock price. If we look at the price targets and forecast section, it correctly identifies this potential for extreme volatility. It notes the low float, only about 34 million shares.
Combined with high short interest, which, creates a textbook powder keg.
That technical description is spot on. But is the connection between that negative operational reality we started with and this technical setup ever really established?
I don't think so. Currently, the volatility setup is treated almost like a separate fun fact, a technical detail to explain why the price targets are so extreme.
It feels like the analysis is saying, here's A, operational risk, and here's B, the volatility setup. But it's not saying A causes B. The weakness is that it misses the chance to use the sheer volume of short interest as hard evidence of the market's deep, deep skepticism about the turnaround.
Exactly. The confluence of negative operating income and high short interest, that's fundamentally why the bet on these future contracts is so explosive.
It's the whole reason for the volatility.
It is. The shorts are betting heavily that UMAC cannot execute. They are laser focused on that cash burn rate. And the bulls are betting the contracts will force a squeeze. That tension is the engine of the volatility, not just a result of it.
So the real opportunity is to structure the analysis so that the financial reality check and the volatility setup are discussed in direct relation to each other.
Yes.
This would show the stock's movement isn't just about future revenue. It's about aggressive speculation.
It's about a battle to force a short squeeze against a financially fragile company. It reframes the whole report.
It reframes it as a deep dive into market combat. The analysis needs to explicitly state that the high short interest is likely fueled by the people focusing only on that negative operational cash flow. That sets the whole stage.
And then the confirmed $3.75 million contract is the catalyst for the squeeze.
Right. It turns the report from just a summary of facts into a dynamic narrative about market warfare, all based on a real-world financial vulnerability.
So let's think about how to do that structurally. Maybe merge sections 3 and 4, or at least resequence them. You could use the volatility setup to explain why the consensus price target of $20.66, which is what, a 58% upside?
Something like that, yeah.
Why? That's such a high-risk scenario. It's tied directly to them fixing that operational income problem. The reader needs to get that the potential upside only exists if they can overcome the very financial issues the shorts are betting against.
By linking the short interest to the burn rate, the analysis makes the price movement make sense. You're showing the reader that this isn't a steady company. It's a potential kinetic event.
The structure has to reflect that explosive reality.
It does. If the contracts execute, the shorts are wrong, price goes up. If the cash burn gets worse, the shorts are right, price goes down. That structural link is the engine of the whole narrative.
This approach would just significantly enhance the robustness of the entire analysis. It would ensure the technical, financial, and geopolitical parts all work together to tell one cohesive story about high risk and high reward.